Folks, a few months ago I talked about bank stocks weakening, and unfortunately I was right. But now we got to deal with part number 2 because COVID-19 is heating back up and bank stocks are headed lower. So let's talk about withdrawing from weakening bank stocks. If you looked at the markets lately, you might have noticed that bank stocks are having a real hard time in the current economic cycle. Matter of fact, most banks are down over 25% from a year ago. And in some cases, the numbers, well, they're even weaker. COVID-19 has increased the risk of loan losses as consumers as well as businesses of all sizes continue to deal with lockdowns and increased unemployment rates. And if you think that wasn't enough, there's even more bad news. Interest rates are going lower, and that means less income for banks, especially ones that don't have big investment banking divisions to offset some of their losses. Moreover, consumer discretionary spending is drying up, and with increased regulations coming from the Fed as a result of increased default guidelines, the entire sector is setting up for another major down move. And I want to outline a few bank stocks or suggest a few bank stocks that you want to avoid buying or alternatively trade to the short side, which you can simply do by buying a put options or just selling a stock short. Again, not all bank stocks are in the dumpster, but these you want to avoid, especially till the economy turns around and COVID-19 becomes a distant memory. The first stock on my list is HSBC. The ticker symbol is HSBC. HSBC is Europe's largest bank by total asset size. It operates in numerous countries and has huge exposure to Hong Kong. Well, guess what? There's a ton of political unrest surrounding Hong Kong and its relationship to China. More importantly, U.S. specifically said they are reconsidering Hong Kong's status as a special financial entity, which could have a major negative impact on HSBC biz. Second, HSBC has the most exposure to emerging markets. These are countries like Brazil, India, and Mexico, where COVID-19 is hitting financially harder than anywhere else in the world. There's an additional risk with banking in underdeveloped countries, and that risk is being priced into the shares of the stock right now. As far as existing financial earnings estimates have been revised substantially lower. Currently, expectations are down by more than 50% or more from a year ago. Earnings per share growth versus previous quarter, 25% negative. Earnings per share growth versus the same quarter a year ago, negative 58%. Technically, the stock looks like it's falling off a cliff and breaking lows as we speak. There was hardly any bounce after February, and I'm expecting more weakness as we head into the fall. The next bank stock on my chopping block is Banco Santander, ticker symbol SAN. Santander is a Spanish bank with subsidiaries in US, Mexico, Brazil, and Chile. Spanish economy is only weakening and debt is increasing. It appears Spain is still suffering from a major downturn in real estate, and there's just not much business growth or home sales at this time. With the rest of the world dealing with COVID-19, I would not recommend this stock at this time. The fundamentals are reflecting a major downshift in the company's business. 5-year return, negative 64%, 5-year revenue growth, negative 39%, 5-year earnings growth, negative 3%, 5-year dividend growth, negative 69%. Oy, oy, oy. Technically, the stock barely bounced from its February price meltdown, and I'm expecting price to continue trading lower in the near term. The stock may appear like a good bargain hunter's pick, but I believe price will trade lower in the coming months, and it's best to avoid Banco Santander's for the time being and for the foreseeable future. Hope that helps. Folks, pay attention and pay attention good. The stock market has a way of pulling the rug from underneath investors' feet when they least expect it. Isn't that right? Hasn't that happened to all of us at least 100 times? And in most situations, traders are not prepared when the market gets volatile. Or even worse, they lose money. Doesn't have to be that way, folks. There's finally a steady way to grow your income from the stock market, and it doesn't matter if the market goes up, down, or sideways. And there's no charades involved. These money links are backed by proven mathematical facts with a 96% certainty. It's how linked stock expert Jeff Zananeri has seen $12,870. How about $13,590? How about $20,380 paydays no matter what the market does? I love it. Click on the link below to learn how you can get your hands on this strategy today.